Ready to build massive wealth? Welcome to your Philippine Real Estate Guide. Let's start building your future today.
Hey everyone, and welcome to this explainer. I'm so pumped you're joining us today because we're diving headfirst into the definitive 2026 Philippine real estate market outlook and investment guide. Whether you're an investor looking to allocate some serious capital or a homebuyer just trying to time the market right, our goal today is to help you cut straight through all that noise and spot the real opportunities. We're going to rely strictly on the latest data and market intelligence to build a clear, structured picture of what is actually happening on the ground right now. I want to kick things off by throwing a question at you, and it's probably one that's been bouncing around in your head lately. Is the Philippine real estate market booming or is it busting? Sounds like a super simple question, right? But depending on which headlines you scrolled past this morning, you might get entirely contradictory answers. You've got reports warning of a tough 2026 thanks to geopolitical tensions and domestic issues. And then, at the exact same time, you've got developers reporting record infrastructure investments and massive foreign retail expansion. So, which is it? Okay, let's dive into this. The confusion mostly comes from looking at the market from way up at 30,000 feet. If you just look at the macro myth, you see a 19.4% average office vacancy rate in Metro Manila. A generalist investor looks at that and instantly sees widespread distress. But look at the micro reality down in Cebu. Office transactions down there just jumped an insane 70% year on year. The truth is, these broad national averages are completely hiding the hyper-specific, booming realities of micro-locations. So here's our roadmap to separate the data-driven reality from those generalized myths. First, a tale of two markets. Second, residential, the buyer's market. Third, commercial and industrial shifts. Fourth, the infrastructure premium. And finally, we'll wrap up with our 2026 investment playbook. All right, part one, a tale of two markets. Look, treating the Philippine property sector as just one single, uniform entity in 2026 is literally the fastest way to misread your risks. Behind the flashy lights of the Metro Manila skyline, the market has essentially split into two totally distinct economies. On one hand, you've got a market shaped by global capital flows, institutional tenants, and foreign brands expanding into prime spaces. But on the other hand, you have a market running purely on domestic consumption, mid-income demographics, and this massive wave of provincial urbanization. Applying a single lens to both of these, you're going to misprice the risk on one side and entirely miss the decade's best entry points on the other. And that brings us to an absolutely crucial mindset shift you need to make. The market is not recovering, it is reconfiguring. Seriously, if you're sitting on the sidelines waiting for the market to magically normalize back to what it looked like in 2019, you are going to be left in the dust. The 2026 market has already moved way past those old assumptions. Moving right along to section 2, residential, the buyer's market. Let's talk about how the leverage has completely shifted. 7.9. That is the number of years of unsold residential inventory sitting out there as of late 2025. Now, context is everything here. Just a few quarters prior, that number peaked at a whopping 13.4 years of supply. This massive, rapid drop down to 7.9 shows us that the market is actively normalizing. We're seeing a really sharp slowdown in new condominium completions, dropping from a historical average of 13,000 units a year all the way down to about 3,600 units projected moving forward. So supply is definitely tightening up. But right now, we are still looking at a staggering 34,400 unsold ready for occupancy, or RFO, condo units sitting in Metro Manila. And nearly half of this is right in the mid-income bracket. Because developers are still holding on to this surplus, it gives buyers incredible negotiating leverage today. You've got access to way better promos, much more flexible payment schemes, and some serious value buying opportunities before that tightening supply pipeline really starts pushing prices back up. Now, what's really interesting here is where the growth is actually happening. You'd probably assume prime business districts like BGC are leading the charge, right? Well, BGC is definitely expensive, forecasting around 325,000 pesos per square meter, but check out those growth expectations. At 4.8%, it's actually being outpaced by fringe and infrastructure-connected locations. Quezon City is tracking at 6.7%, and Parañaque is hitting an impressive 7.7% expected growth. Capital is actively shifting away from oversupplied core CBDs and sprinting toward these high-growth fringes. All right, Section 3, Commercial and Industrial Shifts. Policy changes and post-pandemic work habits are practically rewriting the rulebook here. We are seeing this massive flight to quality in the office sector. Traditional firms, government agencies, outsourcing companies, they aren't just looking for basic desks anymore. They want grade A, master-planned, heavily sustainable spaces. In the commercial market right now, your location and your building quality matter so much more than trying to time the broader cycle. The contrast here is night and day. Over in the prime CBDs, we're seeing marginal rent increases and tighter supply. They're incredibly resilient. But out in the fringe offices, areas that are still digesting the exit of offshore gaming operators, we're seeing elevated vacancies that desperately require new replacement demand. Again, if you treat that headline 19.4% vacancy rate as a blanket condition across all offices, you'll totally misunderstand the risk in the fringe and the massive opportunity in the core. Meanwhile, the industrial sector, it's getting a massive catalyst. I'm talking about the new 99-year lease law, Republic Act No. 12-2052. Previously, foreign investors were capped at much shorter terms, but extending this to 99 years totally levels the playing field with regional neighbors like Singapore and Malaysia. It provides real long-term security, which is rapidly accelerating huge investments in high-tech manufacturing, smart logistics, and hyperscale data centers, especially up in central Luzon. Which brings us to Section 4, the infrastructure premium. Let's look at what's really reshaping property values outside those traditional business hubs. 15 to 20%. If you only remember one single number from this explainer, make it this one. This is the subway premium. Historical global data proves that properties within a 500-meter radius of mass transit hubs enjoy a 15 to 20% value surge compared to those further away. National infrastructure, particularly the Metro Manila subway, is hands down the single most powerful driver of real estate value in the Philippines today. When you actually track the timeline, it becomes super clear why 2026 is the magic year. In 2024, right-of-way acquisitions hit 100%. Right now, in 2026, those massive tunnel boring machines are actively grinding away underground. By 2028, partial operations are scheduled to kick off. And here's the secret. Price capture for real estate starts 18 to 24 months before a station ever opens. The smart money isn't waiting for the ribbon-cutting ceremony in 2028, they're locking in their positions right now. Finally, Section 5, the 2026 Investment Playbook. Okay, time to put all this data to work. Based on the numbers, here's exactly where the smart money is positioning itself. First, RFO condos in secondary CBDs. These offer immediate cash flow and really solid gross yields around 6%. Second, pre-selling units right near those new rail and subway stations we just talked about. That's a brilliant 3-year capital appreciation play. Third, house and lot properties down in the Cavite and Bulacan growth nodes riding the new expressway expansions. Fourth, ground floor retail in mixed-use spaces, which are bouncing back strong as consumer foot traffic normalizes. And lastly, regional hubs like Cebu and Iloilo, which are seeing absolutely massive BPO, IT, and digital nomad inflows, while still remaining highly affordable. But hey, knowing what to avoid is just as crucial as knowing what to buy, right? The data clearly flashes a warning sign against jumping into oversupplied segments right now. Specifically, I'm talking about luxury condos in the Bay Area and speculative studio units in saturated tourist belts. These specific micro-markets are still heavily digesting the oversupply they built up between 2019 and 2023. Honestly, unless you're snagging an unprecedented distress discount, these areas carry a much higher risk profile for near-term returns. So, that leaves us with one final, critical question you need to ask yourself today. Is your portfolio positioned for the averages or for the actual opportunities? We've seen that relying on macro headlines and broad national averages will totally steer you wrong in 2026. The Philippine real estate market is highly localized, highly bifurcated, and incredibly rewarding for the folks who actually dig into those micro-market realities. Ditch the generalities, follow the infrastructure, look for quality, and you will find the real value. Thank you so much for hanging out with me for this 2026 Philippine Real Estate Market Outlook and Investment Guide.